everyone, welcome back to the channel. If you're new here, don't forget to subscribe to our channel. Today, we're diving into something super important for your financial health, your credit score. Whether you're trying to buy a house, get a loan, or just keep your financial life on track, having a good credit score can make a huge difference. It can help you save money on interest rates, get better credit card offers, and even make renting an apartment easier. What is a credit score, and why does it matter? A credit score is a number that represents how reliable you are when it comes to paying back money. It's used by banks, lenders, and even landlords to decide if they want to lend you money or let you sign a lease. Most credit scores are between 300 and 850, and the higher your score, the better. Here's a quick breakdown of how the scores work. 300,579, poor. This score will make it hard to get approved for loans or credit cards. 580,669, fair. You might be able to get credit, but you'll probably pay higher interest rates. 670,739, good. You're in a solid position and should qualify for most loans at decent rates. 740,799, very good. You'll likely qualify for loans with low interest rates and better terms. 800,850, excellent, you're in the top tier, and lenders will fight to give you the best offers. Your credit score matters because it can affect everything from the interest rate on a car loan to whether or not you get approved for a mortgage. The good news? Even if your score isn't where you want it to be, there are plenty of ways to improve it. Understand what makes up your credit score. Let's take a look at what actually makes up your credit score. Once you know how it's calculated, it's easier to make changes that can boost your score. There are 5 key factors. 1. Payment history, 35%. This is the biggest factor. If you pay your bills on time, your credit score will benefit. If you miss payments or pay late, your score will drop. 2. Credit utilization, 30%. This refers to how much of your available credit you're using. Ideally, you want to keep this below 30%. If you have a $10,000 credit limit and you're using $3,000, your utilization rate is 30%. The lower this number, the better for your score. 3. Length of credit history, 15%. The longer you've had credit, the better it is for your score. That's why it's important not to close old accounts, even if you don't use them often. 4. New credit, 10%. Opening too many new accounts in a short period can hurt your score. Each new application triggers what's called a hard inquiry, and too many of these can lower your score. 5. Credit mix, 10%. Lenders like to see that you can handle different types of credit, like credit cards, personal loans, and mortgages. Having a variety of credit types is good for your score. Tip number 1. Pay off debt strategically. One of the best ways to improve your credit score is by paying down your existing debt. But instead of just paying the minimum amount every month, it's a good idea to take a more strategic approach. Here are a couple of strategies that work well. 1. Focus on high-interest debt first. If you have multiple credit cards or loans, start by paying off the one with the highest interest rate first. This is called the avalanche method. By doing this, you'll save more money in the long run because you're reducing the amount of interest you'll have to pay. 2. Pay off small balances. On the other hand, some people like the snowball method, which means paying off your smallest debts first. This can give you a psychological boost because you'll see debts disappearing faster. It might not save you as much money as the avalanche method, but it can keep you motivated to stay on track. Whichever method you choose, reducing your overall debt will lower your credit utilization rate and help boost your score. Tip number 2. Automate your payments. As we talked about earlier, payment history is the single biggest factor in your credit score. Missing even one payment can have a serious impact, so it's really important to stay on top of things. One of the easiest ways to do this is by automating your payments. Almost every bank or credit card company allows you to set up automatic payments online. You can choose to pay the minimum balance or the full balance each month, but either way, automating ensures you never miss a due date. If you don't want to set up automatic payments, at least set reminders on your phone or mark your calendar a few days before your bills are due. Even one late payment can drop your score significantly, so staying organized is key. Tip #3, keep your credit utilization low. Another major factor in your credit score is credit utilization, which means how much of your available credit you're using. A high utilization rate can drag your score down, even if you pay your bills on time. The rule of thumb here is to keep your credit utilization below 30%. So, if your total credit limit is $10,000, try not to carry a balance higher than $3,000 at any given time. Here are a couple of ways to lower your utilization rate. 1. Make more than one payment a month. You don't have to wait until your bill is due to make a payment. If you pay off part of your balance mid-month, your reported balance will be lower, which can help your score. 2. Ask for a credit limit increase. If you've been responsible with your credit, you can ask your credit card issuer for a higher limit. This will instantly lower your utilization rate without you having to pay down any debt. Keeping your balances low is one of the easiest ways to quickly improve your credit score. Tip number 4, avoid opening too many new accounts. It can be tempting to open new credit cards, especially when they offer rewards or sign-up bonuses. But opening too many new accounts at once can actually hurt your credit score. Each time you apply for a new credit card or loan, the lender does a hard inquiry on your credit report. While 1 or 2 inquiries aren't a big deal, several in a short period of time can lower your score. It also sends a signal to lenders that you might be desperate for credit, which isn't a good look. If you do need to apply for new credit, try to space out your applications over several months, and only apply for what you truly need. Your credit score will thank you. Tip number 5, become an authorized user. If you're trying to build or rebuild your credit, one trick is to become an authorized user on someone else's credit card. When you're an authorized user, the credit card's payment history is added to your credit report, even though you're not the one paying the bill. This can help improve your credit score without you needing to do anything. Of course, it's important to make sure the person adding you has good credit habits. If they miss payments or carry a high balance, it could hurt your score instead of helping it. But if you can find someone with a strong credit history, this can be an easy way to boost your score. Tip number 6, dispute any errors on your credit report. Did you know that mistakes on your credit report can hurt your score? Errors like accounts you didn't open, incorrect balances, or payments marked as late when they were actually on time can all lower your score. The good news is that you have the right to dispute these errors. Here's how you do it. 1. Get your free credit report. By law, you're entitled to a free credit report from each of the 3 major credit bureaus, Equifax, Experian, and TransUnion once a year. You can request these reports at annualcreditreport.com. 2. Review your report carefully. Look for any mistakes or accounts you don't recognize. Even small errors can impact your score. 3. Dispute any errors. If you find something wrong, contact the credit bureau directly. You can usually file a dispute online, and they'll investigate the issue. If they find the error was indeed a mistake, they'll correct it, which can improve your score. This is one of the quickest ways to see a boost in your credit score if there are any mistakes. If you found this video helpful, be sure to hit the like button, and don't forget to subscribe for more tips on managing your money and improving your financial health.